Hi, I'm Tom Mihawk, and welcome to my personal finance course. This chapter is called Financial Statements and Budgeting. And as I said when I introduced the first segment, this is the second segment. I said that we could have called this record keeping, or we could have called this spending your money, but there's so many great things in this chapter to talk about, and we introduced in the last segment the concepts of how long to keep records, when to store them, some basic terms like income and expense and assets and liabilities. And now we're going to use those things and talk about a balance sheet. A balance sheet helps you know where you are. Where am I now financially? What's my current financial status? It consists of assets less liabilities, assets minus liabilities equals net worth. It's what you own less what you owe. List first the assets in order of liquidity. The most liquid assets first, like checking account, cash, savings. The least liquid, like real estate and personal possessions, follow after that. This example on the right comes from the Kapoor text, Personal Finance. And it shows that, liquid assets come first, then comes your illiquid assets, real estate, investments, and things like that. Next come liabilities. First, your short-term, generally those that are due in less than a year, and then your long-term liabilities. The difference is your net worth. See net worth at the bottom? It's done for a moment in time. December 31st, September 30th, June 30th, something like that. The balance sheet tells you where you are, what you own and what you owe. The difference being your net worth. You want to have more assets than liabilities, because if you do, you're in a positive situation. You have positive net worth. In the corporate world, we would call this an income statement, but in the personal finance world, we call this a personal cash flow statement. It tells you where your money goes, what you have left at the end of the month, what you have left at the end of the year. It's a flow statement. It measures over a period of time. At the top is income, and you subtract from that your expenses. The result is sort of like your profit. We would call it a surplus or a deficit. Do I have money left or do I owe money? Money left means it's money that's remaining that you can save or invest. Money that you're in a deficit position means you have to borrow or take or sell another asset or sell an investment to get money to pay expenses for that period of time. So it's income less expenses equals a surplus or deficit, or your net cash flow, or your profit or loss. What you earn less what you pay equals the surplus or deficit. Income includes income from all sources. It's inflows from all sources. Expenses may be split into fixed and variable. When I was just out of graduate school working in New York City in investment banking, I had a young child, was commuting to the suburbs. You might think in investment banking, lots of money. Well, after taxes, no. And in the beginning, certainly. And so, I kept a budget like this on a spreadsheet, electronic spreadsheet, and I broke it down not into fixed and variable expenses, but into discretionary and non-discretionary expenses. Discretionary meaning those ones that I could not have to spend that particular month, like entertainment or movies or maybe reducing cost of food. Non-discretionary were things I had to pay, like rent, bills, power bills, cable television, or something like that. And a cash flow statement, a personal cash flow statement, is done over a period of time, over a month, over a year, over a semester. Now, students will sometimes ask me, well, what if I don't have a job? What if I get money from my parents? What if I have a stipend for work that I do? What if I made money in the summer and I draw on it? Well, for this statement, you would show as an inflow whatever you get from the money you take from your summer job, the money you get from your parents. The asset would be what you saved and the savings amount for your summer job. The asset's not your parents. The income is what they give you. The asset, that's kind of an intangible asset, I guess, certainly a valuable one. So that's a personal cash flow statement. Now, a budget is simply a personal cash flow statement adding a few columns, a budgeted amount, an actual amount, and the difference or the variance. Notice in this budget shown to the right, again from the Kapoor personal finance text, notice that you have projected inflows, projected outflows. Notice that they show an emergency fund. This is a great way to pay yourself first. A great way to, before you even start to spend on mortgages and life insurance and property taxes and food, pay yourself first. Pay your emergency fund. It also shows fixed and variable. Remember, I recommend considering discretionary and non-discretionary. Covers a period of time, a month, a year, a semester, 5 years, something like that. And again, it's just a personal cash flow statement with columns added for budgeted amounts, the actual amounts, and then the difference or the variance. You would want to use a statement like this to compare your differences or variances over time. How did I do compared to last month? How did I do the last 3 months compared to the last 3 months last year? How did I do this year compared to last year? So it's a great way to make comparisons, a great way to make sure you're on track. You put your goals in the budgeted column, you enter the actual amounts, and then look for the variances, the differences, and see how you did. Now you may have to adjust up, take from one and add to another. But this is a great way to measure how you do from period to period with your spending. One way to do this, and I'll talk in just a moment, one of the next slides, about methods of keeping these records. But certainly software and apps are a great way to do it. To monitor accounts, you might use You Need a Budget, Mint, Personal Capital. The image at the right showing these 3 iPhones is an example of our screenshots of Personal Capital. Pocket Card is another one. To track your spending, you might use Foreseat or Showboxed. If you want to save more, you might try Digit or Acorns, and then you have the old standby, but it's a great product for checking, doing personal reports, planning, and your taxes, Quicken. Try several, determine which works best for you and which you rely on, and then use those or use that one. Sometimes people say, well, don't download too many apps and then you'll get overwhelmed. I think if you want to have a budgeting app, download 2. Try them. See which one you like best. See which one works. See which one's easiest to use. Which one you go back to. Which one encourages you to use it. Gives you, therefore, the best data. Helps you make the best decisions. And then use that one. The image on the left shows a desktop of a mobile phone with a bunch of different apps loaded. All right, so these are software and apps. Now, systems and methods for tracking. First, mental, right? It's all in your head. This is a bad system. If this is the only way you can, if you take this course and this is the only way you can do it, okay, fine. But doing it all in your head is not the best way to do it. You'll get overwhelmed and you'll forget. The physical way, having envelopes, boxes, piles of receipts, it's better, not that much, but it's but it's better, right? Than keeping it all in your head. A good method is a written method, Use a pad of paper and a pen, It's a good way to do it. Spreadsheets are very good. You can add, subtract, multiply. You can put new things in, make them bigger, make them smaller, make them bold, make them, highlight them. Spreadsheets are a very good way to do things. It requires some hands-on work, but it's a very good way to do it. And then apps and software are very good. Now, they don't always work. Sometimes an app is not as easy as just doing it on a piece of paper or, doing it in a spreadsheet. But until you try, you won't know. So try, download a few apps and see how it works. See which ones you rely on, which ones you go back to, and use those. And try them for a while. I've tried a bunch. Right now, I'm not using any. And I've probably had 2 or 3 that I've used in the last couple of years. I used them a lot in the beginning, and I used them less later. And so I rely on Quicken, where I, and my bank software where I pay my bills. That's a great one. Banks these days used to have to download software or purchase software and install it on your computer. Today, your banks provide these overlays as part of their accounts that they allow you to track. And so you have budgeting apps and planning and charting and those kinds of things provided for free by your bank. Most important, it has to work for you. Be flexible, be repeatable. Encourage you to use it. And be useful for important time periods. If you don't do it constantly, that's okay. The point is that you do it from time to time when you need it for the periods that really matter. Before you get married, before you go to grad school, before you have a child, before you take a vacation, build a budget. If you do it regularly, of course, that's best. And if you can keep up with it, that's best. So for some people, that's fun, pleasurable. It's nice to be that organized, and they enjoy it. For others, it's drudgery. They hate it. And so for those of you, do it when you need it, before you get married, as I said, before you go to grad school, before you have a baby, something like that, before a vacation. Some saving techniques, okay ones, right? Glass jar, piggy bank, save all your coins in it. Take all your $5 bills when you get them, put them away. Better or best, pay yourself first. Actually, that's the best one. Pay yourself first before you pay your other bills. Pay yourself. Make it automatic. This is a great one. You won't miss it. So automatic withholding from your paycheck, have it go right to savings, right to investments, and fill up your 401k every year if you can. Fill up the maximum amount. You won't miss it. And after 15 years, 10 years, 5 years, you'll have assets that you couldn't believe. In fact, you could have $1 million. Now, I picked 45 years because that's roughly the length of time for an undergraduate to make it till they retire. It's roughly the time. But you only need to save $264 a month. Now, I did that on my calculator, right? Just punched it in at 7%, which is reasonable for a long-term investment, retirement investment, invested in stocks. This is very possible. $264 a month, 45 years, $1 million. So this is the kind of goal setting you can do with these financial statements and budgets. This has been the chapter on financial statements and budgeting. This is segment 2. Thanks for watching my personal finance course. I'm Tom Mihawk. You can find me at tommihawk.com, on YouTube, Instagram, at Resume Optimization. Look for me. Thanks very much, and come back for the next chapter.